Welcome to today's Explainer, where we're kicking things off with what is, frankly, the ultimate Wall Street insult. I mean, just imagine for a second the thousands of highly paid, impeccably dressed investment professionals sitting in these towering glass buildings. They've got supercomputers, complex algorithms, and they're all desperately trying to outsmart the stock market. Now imagine walking in and telling them that their entire profession, their decades of rigorous study, and those astronomical fees they charge are essentially worthless. Why? Because they could literally be outperformed by a blindfolded chimpanzee. It's a wild concept that completely turns the financial industry on its head. And honestly, it's the perfect foundation for the fascinating journey we're taking today.
Which brings us directly to this absolutely legendary and totally disruptive quote from Burton G. Malkiel. He wrote, "A blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts." It's just an incredible visual, isn't it? Malkiel, who's a brilliant academic and economist, dropped this bombshell on Wall Street pros decades ago, and it sparked an absolute war between the academics who analyze the market and the professionals who actively trade in it. Because as you can probably guess, financial analysts in pinstriped suits really didn't appreciate being compared to bare-assed apes.
Okay, let's dive into what this actually means. The entire premise rests on a concept called the random walk. A random walk basically means that future steps or directions just can't be predicted based on past history. It's like tossing a coin. When you apply this to the stock market, it means that short-run changes in stock prices are completely unpredictable. All those complex charts, the earnings forecast, the incredibly expensive investment advisory services, they are functionally useless for predicting what a specific stock is going to do tomorrow or even next week. To the Wall Street pros, the term random walk is practically a swear word because it threatens their very livelihood. Think about it. If past performance doesn't predict future results, then nobody out there actually possesses a crystal ball.
So here is our roadmap for today. We'll start with the random walk theory, move into two theories of valuation, take a look at the madness of crowds, explore the flawed human brain, and finally, wrap up with the winning investment strategy.
All right, part one, two theories of valuation. Let's see how the pros actually try to value stocks.
So if the market is indeed a random walk, how do these professionals justify the specific stocks they pick? Historically, they rely on two very different, contrasting theories. First, you have the firm foundation theory. This one is heavily mathematical. It argues that an investment has a firm anchor of intrinsic value that's based on its future dividends and growth. Basically, you crunch the numbers, find a stock price below its true value, and you buy it. This is the realm of Benjamin Graham and his famous disciple, Warren Buffett. But then, on the flip side, we have the castle in the air theory. This throws all that math right out the window. Popularized by the famous economist John Maynard Keynes, who, fun fact, literally played the market from his bed for a half hour every morning. This theory focuses entirely on mass psychology. It's the classic greater fool concept. A stock is worth whatever someone else is willing to pay for it. You don't really care about intrinsic value. You just want to buy in before the crowd does and sell to a greater fool before that castle in the air inevitably collapses.
Moving on to part two, the madness of crowds. This is exactly what happens when those castles in the air come crashing down.
Buckle up because we are now entering the theater of the absurd, completely fueled by pure greed. Just look at this timeline of historical hysteria. Back in the 1630s, the Dutch completely lost their minds over flower bulbs. In 1720, the English threw absolute fortunes into the South Sea bubble, literally investing in companies without even knowing what the companies actually did. Then the Roaring '20s culminated in the devastating 1929 Wall Street crash, and just when you'd think modern, sophisticated investors surely learned their lesson, boom, we rush headlong into the year 2000 internet bubble. Century after century, the greater fool theory sparks mass hysteria, driving prices to unsustainable, gravity-defying heights before they all come violently crashing back to earth. To understand just how absurd these prices became, you have to hear this tragic, yet kind of hilarious story from the Dutch tulip craze. People were trading land, family jewels, and their entire life savings for single tulip bulbs. Now, get this. A sailor returning from a long voyage was rewarded with a fine red herring for breakfast by a wealthy merchant. Sitting right there on the merchant's counter was what the sailor assumed was just an ordinary onion. So he sliced it up and ate it as a relish with his fish. Little did he know he had just eaten a Semper Augustus tulip bulb, an asset so incredibly expensive it could have easily fed his entire ship's crew for a full year. The merchant was absolutely ruined by this, and he had the poor sailor thrown in prison for a felony. But hey, we really can't laugh at the Dutch because we did the exact same thing in the late 90s. Investors blindly threw buckets of money at businesses with zero earnings just because they slapped .com on their name. I mean, we had the Globe.com, a company with literally no profits whose stock soared from $9 to $97 in a single day. We had Pets.com, whose entire business model seemed to revolve around a cute sock puppet mascot that appeared in the Macy's Thanksgiving Day Parade, completely ignoring the fact that shipping 25-pound bags of dog food across the country had terrible profit margins. We even had Easeboard.com, which produced internet pages they literally called toilet paper. It was a total frenzy of money-losing ventures. $8 trillion. Just take a second and let that number truly sink in. When the internet bubble finally popped, over $8 trillion of market value simply evaporated into thin air. To put that into perspective, it was as if the entire economic output of Germany, France, England, Italy, Spain, the Netherlands, and Russia had vanished completely overnight. Which brings us to part 3, the flawed human brain. Let's look at why we keep falling for the hype. Now, after the noise fades and the trillions are lost, we really have to look inward. I want you to ask yourself this directly. Why do highly intelligent people century after century continue making the exact same devastating financial mistakes? Why did Sir Isaac Newton, literally one of the smartest men in recorded human history, lose an absolute fortune in the South Sea bubble? He famously lamented that he could calculate the motions of heavenly bodies, but not the madness of people. Well, the answer lies in a fascinating field called behavioral finance. You see, for decades, traditional economics just assumed we were all completely rational actors, trying to maximize our wealth. But psychologists like Daniel Kahneman, who actually won a Nobel Prize in economics for this exact work, proved that we are not rational at all. Our brains are hardwired with these predictable cognitive biases. When it comes to investing, our brains are undeniably our own worst enemies. This flawed wiring creates a perfect storm of bad decisions, and we methodically fall into 4 specific behavioral traps. First up is overconfidence. Investors consistently exaggerate their own skills and completely deny the role of random chance. Second, we have biased judgments. We start seeing patterns where none actually exist, falling for this illusion of control. Third is herding. We're social creatures, right? So when we see others buying, we unthinkingly join the stampede. And finally, loss aversion. Psychologically, the pain of losing money is vastly more intense than the joy of making the exact same amount. This causes us to hold on to losing stocks way too long just to avoid admitting defeat. The famous economic historian Charles Kindleberger hit the nail on the head when describing the trigger for that dangerous herding behavior. He said, "There is nothing so disturbing to one's well-being and judgment as to see a friend get rich." That right there is the painful, gnawing sensation of FOMO, the fear of missing out. You hear about your neighbor making an absolute killing on some random tech stock or a piece of real estate, and suddenly all logic goes straight out the window. You rush in to buy, and tragically, it's usually right at the peak of the bubble, just before it bursts.
Part 4, the winning investment strategy. It is finally time to find some terra firma. The good news is we don't have to be victims of our own psychology. It's time to step out of the madness and find some solid ground. So what's the crucial point here? The ultimate strategy, the one that Malkiel proves out over and over again, bypasses all of our psychological flaws entirely. The solution is simple: long-term investing in low-cost, broad-based index funds. You do not try to beat the market. You do not try to time the market. You simply buy the entire market and hold on to it. Honestly, it is incredibly boring, and it is devastatingly effective.
And the data completely backs this up. When you look at active managers, those highly paid experts we talked about earlier, because they trade constantly, they incur massive fees and taxes. Those costs eat away at their returns, consistently causing them to underperform over the long run. Then you have those trendy smart beta strategies, which claim they can beat the market by tilting portfolios, but really, they mostly just end up adding higher risk and higher fees. But then you have the total stock market index. It simply buys and holds everything. Because the fees are practically zero and it rarely ever trades, it just lets the natural long-term upward trajectory of the economy do all the heavy lifting. Year after year, it consistently beats the experts. So if you want to be a successful random walker, you really just need to adopt these actionable rules. 1. Avoid herd behavior. If everyone at a cocktail party is buzzing about a hot stock, just stay away. 2. Avoid overtrading. Remember, you are your own worst enemy, so stop trying to perfectly time your buys and sells. 3. Buy and hold a widely diversified index fund.
And 4, let compound interest do the work for you. It turns out, in the world of investing, doing less, sitting perfectly still, is actually the secret to earning much, much more.
As we wrap up this explainer today, I want to leave you with one final, vital question to think about. Knowing what we now know about the random nature of markets, the absolute madness of historical bubbles, and the built-in flaws of our own human psychology, are you going to keep trying to beat the crowd at a game that's literally rigged against you? Or are you finally ready to let go of the illusion of control and take a simple, peaceful, random walk to true wealth? The choice is entirely yours.